Welcome back to the Financial Symmetry Show. Chad and Mike here with you. And as we did last week, talked through questions to ask yourself when you're going through big swings in the market, maybe feeling a little uneasy. This week we're going to dive into some of the data, show you some charts. If you're listening to the podcast, we'll talk through the charts to give you some basis for why we feel the way we do about our investment philosophy and some cornerstones to supplement that. As always, as we're walking through these types of conversations, this is for informational purposes only, right? Entertainment in some situations. It's best used in a personal conversation about your specifics when you're talking about investment changes. This is bigger picture views on how the economy is working, how the markets are responding to that and or leading those things. So try to not use it as pure investment advice. All right. So Mike, as we're kicking this off, we do this every quarter, but every once in a while we'll do it on the podcast here because we want people to understand, especially when they're likely seeing more headlines around things that can create certain emotions that make you want to act. We like to talk through that here. So let's get started just talking about kind of where we've been over the last quarter here.
Yeah. Thanks, Chad. And once again, this is Mike Eklund. I'm excited to be back on the podcast. It's interesting. If those who follow us, we've been doing these market updates maybe in the last 3 or 4 years. It's all on the website as well. And honestly, there are some quarters where we're looking for what content are we going to discuss? Like what has been discussed? Maybe the market didn't really do much. It wasn't many headlines. That was not the problem this quarter. This quarter had plenty of content, plenty of excitement, depending on how excited you were about it or not. But it had a lot going on, so there's a lot to discuss. We'll try to provide you kind of the high-level summary, and then, as Chad mentioned, a disclaimer. Feel free, if you're a Financial Symmetry client, to reach out to your advisor with more information about your specific situation. But a couple things. So one is we primarily look at this on a quarterly basis, but through the end of the first quarter, because the markets were actually up until some of the tariff announcements, the changes that we saw in February, the market for the first quarter, the U.S. stock market was down about 5%. And then that is not a typo. The international markets were up, between 3 to 6% if you're looking at international developed versus emerging markets. And then the U.S. bond market was up close to 3%. So that was through March 31st. Now, it was still, I've added some extra information in here on the results through yesterday. And the U.S. stock market from the peak in mid-February is down about 10%. Now, that actually is less than where it was a couple weeks ago, where it was down close to 18 and 19%. But yeah, we had quite a roller coaster over the last month from about mid-February through early part of April as well. The one thing that you don't hear as much in the headlines and the media is actually the international markets, which is many of you who listen to this podcast and have spoken to your advisor, a Financial Symmetry client, have wondered why are we owning these international stocks. They have outperformed the U.S. stock market by about 14% so far this year. That's not a typo. It's about a 14% outperformance, and that is the reason why we remain diversified, and that's in your best interest as well. And then the final comment is bonds this time around are doing their job. They're boring, but high-quality short-term bonds are returning between 1% to 3% this year. So nothing exciting, but that money's there if you need it for spending, or potentially, depending on your situation, you could sell bonds to buy more stocks. So it was a bit of a roller coaster first quarter, or through, it might not look like it in the numbers, but there was a lot of swings, ups and downs throughout the way. And the last thing I'll mention, I like this quote from Warren Buffett. The investor of today does not profit from yesterday's growth. We see way too many investors look at the rearview mirror. What has done well, kind of like if you look and you buy something on Amazon and who has the highest rating, that does not work that way in investing, as we saw so far this year. If you would have done that, you would have bought U.S. stocks and sold international, and that was the exact opposite of what you should have done.
Yeah, it's interesting the ride you take when you're owning a diversified portfolio. You can go long stretches where it feels terrible. And then you'll have some stretches where it reminds you of why you have that discipline and have made those decisions in the past. So again, this year with that international outperformance in bonds, it's feeling a little bit better than it has in the past. But anytime we get into what we're going to talk about next, you start to get questions around, man, shouldn't we be doing something? What can we do now as a result of what's happened? Because this feels like it's not normal, and that's where we're going with this next slide, because what occurs annually, there is actually some normalcy there that may surprise you.
Yeah, exactly. And if you've seen this slide before, that's great. That means we're doing our job. And this is, I like to say, is kind of our vitamin C, where we like to provide this at least once a year to remind folks. And what it just is showing is that it's from JP Morgan on an annual basis. At some point during the year, the stock market typically on average declines about 14%. Some years, as you see on the slide, such as 2020 during COVID, it declined 34%. Some years, like last year, it was a lower decline, I think between 8 to 10%. So what happens year to year is unknown, but that the fee you pay for those higher in equity returns by owning those stocks is you have to deal with the short-term declines. And historically, they've all been temporary, but the key thing is they do happen every year.
Yeah, and then our next conversation piece here, and we're trying to help you podcast listeners to be able to identify with all of the information that we're sharing in these slides. You can certainly go to the website and watch some of the video if you want to check out the slides as well. But this next one, man, this can feel really good to look at in the middle of the midst of the storms of markets, right? Because it's what comes after that storm.
Exactly. Yeah. For those that can't see the screen, what it's showing is the average stock market returns after a 10% market decline, a 20% market decline, and a 30% market decline. And although those sudden market declines can be unsettling, historically, average returns have been positive. And in some situations, such as a 3 and a 5 year time period, anywhere from 25 to 75% in total aggregate returns cumulative over that time period. So I like to say that I get excited. Chad knows that I get excited when we see market declines. I feel like the market is actually safer because of this graph of potential future higher returns. But I think most people think opposite. They get nervous and say, well, like you said, maybe we should act. Maybe we should go to the sidelines. Maybe we should, sell some and wait till things look better. But the reality is during market declines, that actually is the best time to invest.
Yeah, it's one of the only areas where when you're getting a discount, you don't want to take advantage of that. Just instinctively, I'm saying, right? Obviously, as advisors, we're talking through how to take advantage of opportunities like that. But as we're moving through this next piece, this brings up the questions that we'll get from time to time of, okay, so you're talking about international stocks, foreign stocks. So where exactly are you investing, and then how does that look compared to what we buy in the U.S.?
Yeah, no, great question. And so what this is looking at is the returns by country. So we say, like Chad said, we say international. We're not saying Germany or Ireland or UK. We are just saying international. But the slide is kind of showing a country by country performance. And of the probably 15 countries on this list, the U.S. is the third from the bottom. But many don't realize the first quarter, there were returns over 20% for Spain, Norway, close to 20% for Italy. So there have been some markets that did very well, and this, once again, is that benefited diversification. As much as we keep saying it, and you probably say, oh, here they say it again, diversification, but it is to your benefit over the long term, because we don't know what's going to be the best performer. And it's usually wherever people don't expect it will occur. And that's typically how the markets work. They don't act the way you want it to be.
And when we talk about discipline, that's what it means. Doing things when it doesn't feel good to do them, or it's hard to do them and hard to follow through. And this is certainly one of those on a diversified portfolio. So the next topic, this has been the topic of conversation since what I think was coined Liberation Day, right, in early April here in the U.S., maybe even before that. And we're just going to try to describe what the tariffs are, right, and some questions around how that could impact things going forward.
Yeah, I didn't think it'd be right to have a podcast on the first quarter market performance in 2025 without talking about tariffs, because that obviously has been the topic of the day. So just a simple slide here, just talking a little bit more about why tariffs. From the administration perspective, there is some view of reduce the trade deficit with the rest of the world. So we typically buy more than we export to everyone else. So we have what's called a deficit. If we actually exported more than we imported, we'd have a surplus. But right now we have a trade deficit. So one way to reduce that is to try to incur these tariffs. Also, the goal maybe bring more manufacturing jobs back to the U.S. Now, I think that's a little harder said than done, just given the way that the U.S. economy is set up and how much we've, moved our manufacturing overseas over the last, 20 to 30 years. But that is one of the goals of tariffs as well. But think about it. What is a tariff? Tariff is really a corporate tax. If you import a good and there's a 25% tariff and it costs $100 to bring into the U.S., there's a $25 tax on that tariff that the firm who is importing the product has to pay. So now that product, which was $100, now is $125. What does that cost to the consumer, to people listening to this podcast? Potentially, it's higher prices. That company that's importing that product could just turn around and say, well, that additional $25, I'm not going to incur that cost. I'm going to raise the cost or that price of that product I sell in the market. And so that means higher prices when you go to the store, potentially, if they decide to go that route. So that is the impact from the consumer. And a lot of things why you're hearing so many people against the tariffs is because that would be, a big impact to individuals in terms of more money spending on, potentially goods. From a company perspective, think about the ones now, importing these products that are paying a tariff. In the short term, they have the option to either, like I mentioned earlier, to pass along this cost to the consumer, or they can absorb it internally. And that would mean if you're a public company, you reduce your margins, so you're going to have lower earnings. So that probably is reflected in your stock price, which is why the reason why we're seeing, the impact to stock prices. Another option is you could say, well, maybe we're going to need cut costs, or we're going to lay off employees. That also going to impact stock prices because that means people have less money to spend. In the long term, the hope is, or the goal is for the folks that are implementing the tariffs, is to companies will move some of their manufacturing back to the U.S. Will that happen or not? I don't know. But that's kind of one of the thoughts of the tariffs. The timing of building a manufacturing plant, moving the products back, hiring employees, that doesn't happen overnight. So if that does happen, that would be a long-term impact. And then the final thing is, we've been, the timing of this podcast is, I'll tell you right now, it's April 29th. Anything can change by the hour, by the minute, by the day. And that's why I like to say, tariffs are kind of like a light switch in the fact that they can be turned on and off. And we've seen a lot of that already, where there's initial announcement, then there's a negotiation, and then there's a delay. And so I like to call, because you could turn these on and off, there's a question of will they be implemented or not? And that's to be determined. And that's what the market is doing right now. The stock market is adjusting immediately to the tariff news and calculating the probability that they actually will be implemented or not. And that's going on. And so if we're talking about it, it's already been priced into the market, in our opinion.
And that's why we've been seeing such large swings, right, day to day, because a headline might come out about a pause in the tariffs or a reduction in certain tariffs or increases, and that impacts prices nearly immediately, and it can be throughout the day. So, and that's one thing that can throw markets into a haywire situation. When uncertainty is presented, it's difficult to make decisions on the things that Mike was talking about around a company's impact, because leaders at companies, executives, are trying to make decisions based on what they know is to come, and when you don't have an idea, that makes things really difficult to forecast. So as we're looking still here at the how things historically have looked around tariffs, let's talk about this a little bit.
Yeah, tariffs are one of those items. You think about politics, and it's very rare that anyone in Washington can agree on anything, really, over the last 10, 20, 30, how many years you want to go back.
That's the one thing we can agree on.
That's what I was going to say. Tariffs have seemed to be the one thing Democrats and Republicans have been able to agree on, and that's what this graph is showing, is that really since the 1900s, a little bit in the 1930s, since then we've seen a significant decline in the tariff percentage or historical tariff rates, down to really before this announcement kind of in the 2 to 3% range of the products that are imported. And with the announcements that came out and what Chad mentioned, Liberation Day had bumped that tariff rate from about 2 to 3% to 22%. So this was an unheard of increase, and so resulted in that material changes in the market. But we were seeing the market moving by 5%. One day was up by 10% in the middle of the day. These are moves we have not seen in years, and some of the largest moves in history, honestly, in the stock market. But it's just the magnitude of these potential tariffs are something that we haven't seen since 1909. So the market's still trying to reflect kind of what does this mean to the stock market, and what's most important to the stock market is future earnings and the impact to companies.
And that's what we're moving to next. So let's look at we're going to talk through this, but man, there's a lot of red that occurred on these screens when talking about performance throughout the first quarter, right?
It is, and I always love, and Chad, I'm sure you received this as well, as people say, well, how's the market doing? I always like, what is the market? I'm always curious, what is the market? There are 10,000 public companies throughout the world, and everyone defines the market differently. And what Chad was referencing, the slide we're looking at right now, shows every single stock in the S&P 500 individual companies, and how they did in the first quarter. And on this page, there's a lot of red, which are companies that had negative returns. And there are also a lot of greens for companies that had positive returns. A lot of the red is more centered around certain companies that really had all the headlines the last few years. This is companies like Google, NVIDIA, Apple, Microsoft, Broadcom, Amazon, Tesla. They have, in this page, they're seeing very, very large red numbers because they did very poorly in the first quarter. But the reality is, excluding those big 7 companies they called the Magnificent Seven, there's a lot of green. Berkshire Hathaway, I saw IBM, I think we had green in there. Coca-Cola had green. There's a lot of green, strong performance, where the reality was, if you exclude those Magnificent Seven companies in the first quarter, you actually had a 1% return in the S&P 500 versus the negative result. So just sometimes the best performers could end up being the worst performers, the following year, which is why we obviously don't recommend putting all your eggs in one basket.
And if you are just listening to the podcast, I'd recommend you check this out, because it's a really interesting contrast to see the different sectors and how things move at different times in the markets related to certain areas. And it kind of has bigger squares for the larger companies versus smaller squares for the smaller. So just an interesting dynamic piece there to take a look, even as short term as it is. So if we move in to a little lesson, things that we've talked about here in the past of different market environments where you might have experienced not exactly like conditions, but similar, right? So talk through some of the things that, I know we've talked about this on the podcast before, Mike, but I know you like this one in particular.
I mean, this might go down as in my, the top 5 favorite charts that I've ever looked at. This might be in that list, just because it shows my age. So I started investing in 1999, and this is where I could look at this list of 16 companies: Microsoft, Cisco, Oracle, Sun Microsystems, EMC. I owned almost all of these individually, because that was what you did in 1999 when everyone said you had to own technology. And it now looks over since the last 25 years since that time period, when everyone thought these companies like Cisco and Oracle and EMC were going to take over, the economy and the stock market. Only 2 of those 16 companies actually outperformed the S&P 500. And, it shows how challenging it is to beat the market as an individual company. Technically, just under half survive over a 20-year mark. So a lot of these companies went out of business. 6 out of the 15 no longer exist. And typically only about 1 in 5 outperform the market. The situation, it was 2 out of 15, so even a lower percentage out of that. So it's just a reminder, whatever you think is the hot new stock, which lately has been NVIDIA or Tesla, however you want to say it, historically has not been the strongest performer going forward. So just be cognizant of putting all your eggs in one basket.
Yeah, but how about that overconfidence?
Yep.
Right? It's like we all believe at some point throughout our investing journey, likely that we can be the one to pick the winner, right? But that stat, just under half survive a 20-year mark, is astounding to me, and strong evidence against trying to select the individual stocks. So as we move along, we've got a quote here, I think, that can sum up a little bit of what we've talked about.
Yeah, I mean, this is a quote by David Booth, the founder and chairman of Dimensional. And it's kind of the approach that we take. By owning a broad slice of global markets, we can participate in the upside of human problem solving and innovation wherever it occurs. Going back to that previous slide and looking at the names, I was listening to a podcast this morning and they were talking about the BlackBerry. So that's also kind of timing at the time, the mid 2000s, before the iPhone came out, like BlackBerry was everything. You had to have a BlackBerry. And where is BlackBerry today? They effectively no longer exist. And so that's why we want to make sure we don't know who the next, Amazon or, NVIDIA is going to be. But that's why our view is you want to own the entire market to take advantage of whatever that great company and innovation wherever it occurs.
I did have a BlackBerry. You?
I did have a BlackBerry, and the one before the Black was at the
Nokia.
Yeah, the Nokia was very popular. The Nokia was very popular.
StarTech, Motorola's. Yeah, we could go on and on.
So,
as we transition to talk about investments, obviously are a big piece here of what we're talking through, but there is also a tax element to investments, and whenever you're in market declines, there is a silver lining there, and we'll link our blog post on that. But we do have a graphic that explains this a bit.
Yeah, now this is it's called tax loss harvesting. We talked about this on previous podcasts. We have a blog post at Financial Symmetry, a link on the page as well. And when you say, what should I do? This is a great opportunity to help save you some money in taxes when we do see market declines. If you have a holding, like in this situation, we're talking about someone who owns a ETF called SPY, which is the U.S. stock market. If it declines, you could technically sell that holding and then move into a different holding, not identical, realize that loss, but still stay invested for long-term growth. So this is obviously what I said before, called tax loss harvesting. It's a way to reduce your taxes over time. It's a way to, quote unquote, do something, but not sell and get on the market and wait for things to, quote unquote, look safe.
Exactly. So if your advisors, be on the lookout if your advisor's making recommendations for that, if you are a Financial Symmetry client, but if you are managing your own portfolio, something you take a look at there to see as an option to avoid possibly selling things just to sell things, right? Have a purpose behind what you're trying to accomplish as it relates to your overall goals and investment plan. So if we're thinking about cash options, how are we thinking about that going forward here?
Yeah, and I know this is something that less lately, but for a while there, people were just thinking, "Hey, I'm just going to put money in the bank account, earn 4 to 5%, and I'll just wait till things look better in the stock market before putting money back in there." The reality is the rate you get in the bank or a treasury bill is going to depend on the federal funds rate, which, based upon this slide, is expected to decline probably anywhere from 0.75 to 1% over the year. So that means the Federal Reserve is expected to cut interest rates 3 to 4 times this year, which as a result means the interest rate in your bank account will likely decline. And also any kind of short-term bond funds, that rate will likely decline after time, which is why, once again, we recommend that, the bonds are great. It's boring for short-term cash needs, but for long-term growth, really owning, companies or equities is your best interest.
So we've talked about a couple options that you have or activities that you could look at to take advantage of. We've got a list here to think through as you're evaluating where you are and what you might be able to do to take advantage of. So let's walk through these tips.
Yeah, no, this is, once again, if you're a Financial Symmetry client, great time to go reach out to your advisor, ask a little bit more about your specific situation, about our investment plan. If you're not, number one is follow your investment plan. If you don't, then I think it's a great time to talk to someone like Financial Symmetry or a fee-only fiduciary that can help you implement one, because I think the key driver of your long-term success is going to be having a plan. What to do in this kind of markets, and this is, I've heard from another advisor, I like this quote, bad investors sell in down markets. You don't want to sell low and buy high. That's not a good recipe for long-term success. Good investors hold, that's just not do anything. That's better than selling, but great investors will buy in down markets. Now, based upon the situation, it makes sense to how much you buy and when you buy based upon your investment plan, but really we believe in at least staying the course or buying if your situation allows for it. The next thing which we just talked about was the tax loss harvest opportunities. You, based upon the type of accounts, whether or not you have a taxable brokerage account or not, when's the last time you bought the holdings in your account, you might have the opportunity to implement what's called tax loss harvesting. You might not. That's where, once again, working with a professional, there's also some tax laws in terms of the timing of when you can buy and sell to avoid things called the wash sale. Great opportunity to work with an expert to help make sure you don't come afoul of those rules as well. And then in addition here, for those that are, and we've included this before, but this is a link to our rules-based investment process. That's the one thing great about our approach is that, even when the market's down or up, we have a process, we follow the process for the last 25 years, we're going to stick with it. It's worked out well for our clients. We don't have to think, is the market going lower? Is the tariffs going to be implemented? It's a very sound investment process based on research and evidence. And then finally, I got resources here. So I was fortunate enough to, I was out in New York in March attending the premiere of what's called the Tune Out the Noise documentary. This was an investment history documentary by the individuals at Dimensional Fund Advisors. So I have a link to their YouTube video there, which most say, why would I spend an hour and a half watching a investment documentary? But my wife came with me, who has no interest in investments, and she actually enjoyed the film. So I will say, from anyone who's not into investing, that's it might be something you might want to check out as well. And then finally, there's more. Like I said, we've shown in the past like a more detailed look at the optimal mix of stocks versus U.S. versus international bonds and bills, and that's an updated academic paper on the life cycle investment advice that some find interesting as well.
That's only a cool, 75 pages or so?
I think right? 85, actually, the updated version that
there
was updated in March of 2025. So,
go.
That's some additional information there. But as always, you can reach out to your advisor with additional questions.
And just as a reminder, walking through our 3-step investment process here.
Yeah, I try to keep it simple. A, own equities as much as you can. That's stocks, companies, whatever you want to call them. 2, diversify. We talked about that at the beginning. U.S., international, large, small, many companies, not one. And then final, rebalance. Avoids fads and fears. Just stick to your plan. Helps you buy low and sell high.
Fantastic. Well, I hope this has been helpful. As always, just summarizing, you can check out the Financial Symmetry strategy in the show notes. Let us know any questions. You can send that to your advisor. And lastly, if you are not a Financial Symmetry client, you've been listening to the podcast for a while and just wanted to find a way to reach out, it's right on our homepage, the Talk to an Advisor button. You can click that, fill out a few things, and then one of our advisors will be getting in touch with you to have a conversation to see if we'd be a good fit to help you. Because sometimes, it might be a second look, just a kind of a checkup to see how things are going. There might be some opportunities that you've thought about, read about, had a question, just not sure exactly how to implement, or you may be busy. Like Mike and I were talking about our schedules today. So it's, when you have kids and family life, work, a lot of things, it's hard to make sure things get done sometimes. So we'll have our contact information in here. You can send us emails if you'd like. And then, as always, you can check out the YouTube channel as well. A lot of different videos we have there. Our website, tons of articles, good information. You can search there as well if you have one specific topic. Thanks, Mike, for putting this together, as always. And we will talk to you again in 2 weeks.